represent them. But
And I wanted to make sure.
I put in a 3%
fee.
fee.
Yes, ma'am.
And they said, we don't have any problem with that, we'll just raise, we'll put the 3% fee into the price. I said, that's fine. So,
That's awesome. Hello, Melanie.
Okay, cool. Thank you. All right.
Beautiful, beautiful, beautiful.
is it pretty quiet in here during the week, though?
It just depends, because it's last week was graduation week, we'll probably, and this is the last full week of school. Schools are letting out, starting to let out. It'll probably be pretty dead. Summertime, it can be pretty dead in here because everybody's so busy out showing and stuff. So the busier you guys are, usually the more dead the office is.
Okay.
Yeah. In the winter, it's pretty busy in here because nobody really likes to go see houses.
That's kind of, I'm kind of was hoping that, there for a while, there was a lot of homes that was coming up that was, because I still have a couple
everybody today.
Here you go, sir.
Oh,
You're unmuted and you're recording.
well, thank you.
You're welcome.
Morning, everybody. We're being recorded yet again. So all of these are now going to be online on the Facebook page.
We're actually making a drive file for Google Drive, and we're categorizing everything.
That is awesome.
So I'm gonna be here today. Not really.
Oh.
I'm just going this way.
Hold my hand.
It was.
Please stop.
We're close like that.
Okay, so we are going to start.
What she said.
We started taping these 2 weeks ago, so there will be a drive that contains all of the contract classes so that if people are unable to get here, at least there will be a place to go and watch. Yes, you're going to get my squirrels because I'm not going to edit them out. And so that is going to be a part of it. Last week, we had started going over the uniform contract. We had gotten through page 1. And again, May, this is the Topeka contract, not the Manhattan contract. So just be aware of that. Information is still the same. You need to know what these are on the Manhattan contract as well. Placement is different on the contract form as from Sunflower. We got through page 1 and we had gotten to page 2, I believe. Is that correct? Okay. So we're going to go ahead and start with page 2. Did anybody have any questions on page 1? It's pretty cut and dry. Seller, get it from the tax records. That is the name of deed. That is the name in which the deed has taken ownership. Buyer, write it as they are going to take ownership. We talked in detail about the joint tenancy with right of survivorship, what that means for your client. County goes in here, regardless of which county in Kansas that it is. Legal description, do not have to complete this. You can put as it appears on deed, whatever you want, or leave it blank. Those are your choices. Commonly known address. For the Topeka people, make sure you go over this paragraph in detail with your client. Anything that's in here stays unless specified differently in this box. Purchase price, the amount of the purchase. This will automatically fill in if you're in dot loop. If you're handwriting it, this is written like a check. So if it's $135,000, you're going to write 135,000 and no hundreds in this line. So fill it out like you do a check. Earnest money, what type of earnest money, how much goes here, and how it is to be received goes here. If it is a direct deposit, if it is a wire, if it is something done differently than a traditional check, money order, or cashier's check, make sure it's delineated here. They will come back and require an amendment to correct this if this form does not match the way that the earnest money was received. And then you're either going to be paying cash, assumption of existing mortgage, which we have not done yet. Haven't had any need to do these in my entire years of a real estate agent because the interest rates are so low. May come into play here in the near future as interest rates start to rise. And we've got clients with 2 and 2.5% interest rates. It might be advantageous for the next buyer to assume the loan. So this probably is going to come within the next year to 18 months. Installment sale is a contract for deed that requires a special addendum. We're not going to go over this in class because they are rare. However, if you do have one come up, get with an experienced agent to help you go through this, or myself. New mortgage, this information is provided to you from the lender. Pull it directly off the pre-approval letter and you shouldn't have any problems. Compliance appraisal requirements, make sure this gets filled out. It's a negotiable field between the buyer and the seller, and the dollar amount typically is $150 or less. Okay, on loan types, we have conventional loan, VA loan, FHA loan, USDA rural development loan. These are the parameters in which we go. On a conventional loan, you have two types of loan. It's either going to be fixed or adjustable. And again, this is information that you garner from the lender. It is expressly agreed that notwithstanding any other provisions of the contract, the buyer shall not be obligated to complete the purchase of a property or incur any penalty by forfeiture of earnest money or otherwise. This is very important right now because we have deals that are canceling because they're not appraising due to the market. If that occurs and the seller doesn't come back to do that, to negotiate, then, and it gets killed, the buyer is entitled to their earnest money back because it was through no fault of their own, the contract didn't close.
Chris, I have a question on that. Can I ask something really quick?
Sure.
Okay, so I just had a listing that I listed it, and we listed it pretty far up there, and we had lots of contracts and offers come in on it, and the highest offer. I mean, even I saw it. I'm like, I don't think that it's going to appraise for that. So are agents using that as like a method now of, well, we know it's not going to appraise for this. We know that our buyer isn't going to be able to cover the difference. Is that just like a method that we're doing now, or how do you handle that?
Okay.
Just like shooting the number out there, just to get it.
That is a very, very good question, and it is a very, very good point. And I will share with you how I do it. I'm not saying my way is the right way. I'm not saying my way is the wrong way. I'm just going to tell you how I do it so you guys get an idea. Okay, if you have a property and you know the property is within specific parameters and you have an agent that writes you a pie in the sky offer, if you will, you have a right as a listing agent to go back to that buyer's agent and say, do you really think the house is going to appraise for that? Do you have comps to help support the price you wrote the offer for? And is your buyer willing to pay the difference between the appraised value and the purchase price? If they tell you, no, we're going to buy it at the purchase price or the appraised price, we're not going to do it, then your seller has the right not to accept that offer. That's not the best offer for them. And like I've shared with you guys before in other classes, it is the seller's sole discretion as to what contract they do or do not use. Now, I personally have had sellers that when we got offers, and this actually occurred before the big boom, I had a listing, it had 9 showings in one day, and we got 7 offers. And this was like 2 years ago, okay? But the house had been completely gutted, renovated, etc., and it was a good price point. When we got the offer that we reviewed them. My seller happened to be somewhat savvy with the real estate market. And when he looked at those, there was one offer that at the time was $13,000 over the list price. That seller looked at me and said, what is this guy doing? It will never appraise for this amount of money. And I looked at the seller and I said, you're probably absolutely correct. And there's inspections, etc. So, Mr. Seller, based on the contract, if it doesn't appraise, you can be asked to reduce it to the purchase price, its appraisal price, make those become equal. I said, and you're still going to be out the potential repairs for inspections. And he looked at me and said, I don't gamble. throw that offer off the table. I was like, okay, we got rid of it. Looked at the next 6. And again, it's our job to inform the client with the best of our ability what is the best avenue for them to go. But ultimately, it's their decision. Contract price does not mean that you have the best offer. There are lots of things to consider when sitting down with a seller to negotiate an offer. You've got to look at the price. You have to look at whether or not you feel it's going to appraise. You need to pull your comps. You need to look at those. I never present offers to a seller without the most current comps with me, so I can say, this is what has happened since we've listed the house. Now, right now, we don't need to do that because houses are selling multiple offers in one day. So your comps are going to be good that you use to list the property. But again, you go back and you tell the seller, third-party independent appraiser is going to come in here and tell us what the house is truly worth. We can give you the information we can all day, every day, and do the best job we can at coming up with a potential price point. However, the appraiser is the one who has the ultimate final decision. I can tell you that we had a property this week that the house was listed for approximately 115. There were multiple offers on the table. The offers came up as high as 130, and it did not appraise by $26,000. It didn't even appraise at the list price of the property. And the deal died. And ultimately, the buyer had a moving van in place in their driveway. They didn't kill the deal until the day of closing because the seller refused to reduce the price to the appraised amount. They had tried to negotiate a counter and the seller didn't go for it. Now, what I will tell you in this particular instance was part of the reason why the buyer bought or the seller took that offer was 2 things. The original offer was written for 130. Some of the caveats within the offer were the buyer was going to pay the seller's closing cost up to X dollars. And the buyer was going to pay and guarantee $2,000 over appraised value if it appraised low. Okay? So, looks like a great offer. Buyer's bringing $2,000 extra to close. Buyer has agreed to pay the seller's closing costs, and the buyer was pre-approved for the dollar amount. At the end of the day, it didn't appraise by $26,000. Buyer's bank said, we're out. We're going to reduce it to the appraised value. The buyer said, no, can we at least push it? So they came up to 110. House appraised at 104-ish. They got up to 110, but in that 110, they took away the seller paid closing costs by the buyer, and now in turn needed $3,000 from the seller to close at 110, so the counter was really 107. Again, we aren't the determining factor in the final purchase price. The appraisers are. So when you're sitting down and you're meeting with people and you get these offers that are $10,000, $20,000, $30,000 over the list price, please be realistic with your sellers and say, this is not realistic. And there's going to be, an issue come up down the road potentially. Some sellers are willing to make that gamble because they believe, quote unquote, that there will be no money left on the table and they are going to get the true appraised value for their property, regardless of what the loan amount is.
So is this even ethical, like in terms of buyer's agents? Does that not violate any of those ethical rules that we, live by? Or is this just really a negotiating method that we're using now?
It's a negotiating method that has been developed, and there's just really no way to combat it. And that's why, as a seller's agent, go back to those offers, go back to those agents and say, you wrote an offer for $30,000 over list. What are your buyer's intention? Are they going to come up with the difference in cash at closing between the purchase price and the appraised price? And if that agent says, no, we're backing down to the appraised value, that's necessary information to negotiate the balance of the other offers that are sitting on the table, because you may have another offer in there that's 120,000 versus 130,000, much closer to the list price of the property, has a much better chance of appraising, but that agent may have wrote that the buyer's willing to bring $2,000 over closing up to X dollar. Now, the other thing that I want you to be careful of, and one of the things that the agent could have done differently to make sure that everybody understood, and again, I don't know that it would have helped in this particular situation, but could have written something to the effect of the buyer agrees to pay up to $2,000 over the appraised value if the appraisal is short, up to the purchase price of whatever the list price was. Then everybody knows that at that point in time, we're going to at least get list price for this house.
But do you think that if you were to put that in the contract, like in the additional provisions, do you think like an appraiser would see that? And do you think it would affect the appraised value of the house? Or
Appraiser.
do what?
And what I will tell you is that appraisers do look at that. I have gotten calls from appraisers regarding that. And there's one appraiser who appreciates that people are putting it in there, because quite honestly, it makes them feel like the burden has been lifted off their shoulder. So whether it's right or wrong,
Yeah.
I don't feel, and this is just my personal feeling, it's not a broker statement at all. It's just my personal feeling. But if a contractor, a vendor, an appraiser, a lender, they get a copy of the contract. They get everything. So when they get everything, the appraiser knows what it has to appraise for because they have the purchase contract. Do I think that that can affect the appraisal? Yes and no. My favorite appraisers are the ones who go out there and truly appraise the property and not come back with, oh, it appraised for 500 over purchase price, or it appraised right at purchase price. That tells me they got to where they needed to be and they were done, which is what they have to do. But a true residential appraisal, if there's equity in the property, will reflect that. I mean, I personally in my career I've left $8,000 on the table for a seller in the past because we got a true residential appraisal when it went under contract, and that appraiser evaluated the house $8,000 more than what we took for the house. So I just happened to be on both sides of it, is how I knew. But honestly, when we wrote the offer, I thought we wrote it very competitively. And again, this was before this boom, but I was really surprised when I found out I had left $8,000 on the table.
But even still, it's still appraised value, not market value. I mean,
Well, basically what it said was they could put the house on the market the next day
but would
for
someone buy
8,000
it?
more.
I mean, Probably,
Probably.
in this market for sure, but
Even then.
Yeah.
But it was a really hard one to market because, again, and I've said this before, and and I tell my clients this too, you want the second nicest house on the street. You don't want the nicest, because you want that one to be above you somewhere in pulling the comps and that kind of thing. Turn that bar. Okay, so yes, it is an issue, Melanie. Does that answer the question? Use what you know to help the seller, and make
Okay.
sure your
Yeah.
seller understands the appraised value, and that if it doesn't appraise and if it doesn't close, the buyer will get their earnest money back. Okay?
Okay, thanks.
Yep.
Well, and I had a buyer, we looked at a home and she really, really, really wanted it. And I'd already had talked to the seller's agent, and she said, well, we've got 5 offers already. And I said, oh, I know my client's gonna love this home. And so she had explained to me, about going over and everything. So I talked to my client and I told her, I said, now we can go over. I said, but if it doesn't come in and you really want it, you're gonna have to come up with cash for the rest of it. And so she made an offer, but she didn't go up too high. I mean, she was outbidded, but that was probably good on her part because,
Right.
she
Take care of your client.
yeah.
Okay, but be realistic. And I will tell you that in the situation that I had, the 2 years prior, that the agent wrote the astronomically high offer, called me when it was all said and done and found out they didn't get their offer, and was furious with me. And it's like, I know our offer was the highest one. I said, you're right, it was. It absolutely was the highest one. Well, then we should have got the house. I said, no. I said, my seller threw your offer off the table and quite frankly said that if you thought it was worth that kind of money, that you probably weren't the real estate agent that he wanted on the other side of his transaction. And the agent said, well, you left money on the table for your seller because you would have at least gotten every dime it appraised for. And I said, and you had inspections, and there was a couple of other things. The seller took an offer that had no inspections and had a pre-approval letter that was guaranteeing that if it didn't appraise, they had the proof of funds to pay over. That's the other thing. If you're in a situation where you are in a position of negotiating a contract and that contract has an it's elevated over the list price, and you've talked to the other agent and they've said, my buyer's bringing cash between the purchase price and the appraised price. If it doesn't appraise, get proof of funds. Because if you don't get proof of funds, you don't know if they really have the cash to close. And for the contract, as it's written, they don't have to purchase. Okay? It's a very sticky situation right now. VA, enough unconventional? Okay. VA, the VA loan amount plus any funding fee not paid in cash as outlined below shall be guaranteed by the Department of Veteran Affairs. First blank is, these are negotiable, but again, based on the climate, based on everything that we know, this is going to be the buyer shall pay the discount necessary to secure such VA loan up to a maximum of blank. Now, make sure when you get your VA appraisal or VA pre-approval that there are not hidden discount points in that process. I will tell you that Quicken charges their VA buyers a 1% discount point to originate the loan. Okay, no one else does it, but they will. make sure that you know that the buyer is not paying any points. And the reason that's important is because if it says the buyer shall pay the discount necessary to secure such VA loan up to a maximum of 0% of the loan amount, and you find out that that VA loan charged him a 1% or 2% point fee, then this contract really becomes null and void because you said the buyer would pay up to 0%. So make sure that you've talked to the lender. The funding fee not to exceed, I can give you the first time utilization, and that's 3.6% of the loan. If they're using their second eligibility, if they've already used a portion of their eligibility through their DD 214 and everything associated with the VA loan process, this number is going to change. So the 3.6% is typically the original funding fee for a non-disabled veteran. If it is a disabled veteran and they have a minimum of a 10% disability, the funding fee is waived by the federal government. So let me repeat that. If the buyer is disabled through the VA, 10% or greater, the funding fee is waived, and then this becomes NA. May, you had a question?
You went back over the part about the 3.6%, and that's for someone who has never used their VA. The question was, if it's the individual, I'm just learning more about the VA. Is it only like two married people and it's just the spouse that is the veteran, or do they take both parties in consideration in that application? Do they do it as
both parties? And can I share your situation a little bit?
Oh, cool.
Okay. May and her husband are looking to purchase a personal residence in Manhattan or Fort Riley right now as we speak. Okay. May's a licensed agent. Her husband is active military. So he has his VA benefits. So May and her husband are going to be buying through the VA because of the $0 down program. Now, her husband's not disabled, right? Or
Correct.
Okay.
No, he's not.
So there's going to be a 3.6% funding fee attached to that loan. The funding fee goes over and beyond the purchase price. Okay, so that's added to the loan amount, basically. And what you're doing is you're paying that funding fee because it says shall be paid by buyer as follows, amortized into the loan. So there's going to be a monthly charge for that funding fee until that funding fee has exhausted, similarly to the fees associated with FHA on PMI. Okay.
Okay.
And then again, we have that same paragraph as above. It is expressly agreed that notwithstanding any other provisions of the contract, buyers shall not be obligated to complete the purchase of the property or incur any penalty by forfeiture of earnest money or otherwise if the contract purchase price exceeds the reasonable value of the property established by the Department of Veteran Affairs. However, the buyer may proceed with the purchase without regard to the amount of reasonable value as established by the Department of Veteran Affairs. The seller shall, in addition to any other sums provided for herein, pay all costs associated with obtaining the buyer's loan, which the Department of Veteran Affairs will not permit the buyer to pay, provided said costs do not exceed. And usually I put like $175 here. There are certain fees attached to a VA loan that the seller can't, or the buyer cannot pay legally. So just, and it's a minimal charge, but it would go right there. VA loan. There's really only two types of VA loans we're gonna contend with, and it's a 203B as in boy, 203K as in Kevin. If you get into a 203K situation, that requires another conversation. For that purpose, we will hold off until somebody has one. But a 203K is a construction loan on an FHA property that needs renovations.
So would you recommend that at all for like investors that want to kind of buy and flip houses?
If they qualify, some banks won't let investors qualify. Depends. Okay. They're not typically going to buy FHA ever because most banks require 20% down for investors. They have to have skin in the game for them to take them on. So investors most typically are going to be on a 15 to a 20-year max loan conventional. Typically, the interest rate is going to be adjustable, and the interest rate is going to be higher than a traditional purchase. So investors are treated a little bit differently. The other thing is FHA has a maximum number of loans that you can have at any one time. So that plays into it as well.
Yeah.
It used to be that a lot of people bought FHA because it was the cheapest way. Investors bought FHA because it was the cheapest way to purchase. They only required 3.5% down. Since conventional financing has lowered their down to 3%, typically, that kind of went by the wayside, if you will, because most investor portfolios are going to go conventional because the interest rates are what they are.
Well, and then there's still an issue with owner occupancy, correct? I mean, if you tell them that, yeah, I'm gonna live here, but then if you're truly doing it for investment purposes, it's not true.
That's true. But that's changed too from what it used to be. So yes, FHA, not every FHA is going to require owner occupant certificate. Okay. It's very rare that it won't. But again, it depends. You can buy, and let me just share this. You can buy a second home FHA as a primary residence and go through that process if the house you have no longer meets the minimum requirements to raise your family, or B, it's under contract to sell. Now, what I will say is they watch it really, really close. And I can squirrel, I'll squirrel real quick. I had a client, they outgrew their house. It was a 2-bedroom, 1-bath house. They had 3 kids, married couple. They had to buy. They could not stay in their existing house. It was not big enough. They didn't even meet the minimum square footage requirement for foster care if they were foster caring their kids, okay? They got approved for FHA financing for a second purchase while still maintaining their first home as FHA. It was listed for sale. It closed. They moved. And here's what can happen if the FHA finds or hears wind of you owning 2 houses as primary residence. These people, we tried to sell their house. We couldn't sell it. It was in a terrible situation, location-wise and everything else. We tried for a year and couldn't get it sold. So they're like, we gotta rent it. We can't afford 2 house payments anymore. They put a renter in there. There was some mail that came from the Federal Housing Administration to the address, and it got returned as no longer lives here. The FHA came in and said, do you not live in this house? We're like, no, we bought another house. We're calling your mortgage due. And it wound up going into foreclosure because FHA would not allow them to rent the property. So they mean business.
Got a question.
Now, it was wrong in my opinion, and we tried and tried and tried to fight it, but we
You
lost.
think that they would, be able to,
You have to remember, a lot of these bureaucrats are sitting in Washington behind a desk and they have no idea who they're talking to. So, yes, ma'am.
I understood what you said about the FHA. Is it any one of these, whether it's conventional, I think I got the grasp of the FHA. Are you allowed to buy, I mean, nothing to do with a VA. Are you allowed to buy more than, or apply for, or buy more than one house?
Yes, but you're gonna go
All
conventional.
conventional, or is it, which one of those you can?
You can buy rent, you can own an FHA home and live in it and buy rental properties through conventional means.
Okay.
So you can own multiple loans and still have your primary residence on an FHA loan. You're gonna go back to conventional for your investment properties. And really, this FHA section, it used to be when I started real estate, everything was FHA. Everything was FHA. Conventional people, these were people that didn't qualify for FHA for whatever reason. This was these two were typically your go-to types of loans, the VA or an FHA. It's like everything appeared to be government related. Then we had the crash, what I call the crash, in 2009, 2010, when we had a huge foreclosure boom. Because all of these loans that were written under FHA were going defunct. Part of it was there was a mixed loan type, but we're not going to get into that. Just know that there was a huge FHA blunder, if you will. That required, or as an end result, I won't say it required, but as an end result, the Federal Housing Administration went back and they revamped their loan structures. So where you either had a conventional less than 20% down loan or an FHA loan, you had PMI. The PMI on a conventional loan and an FHA loan dropped automatically once the value of your house hit 78%, 78.5%. It went away. After the foreclosure rush, FHA said, oh, no, we can't do this anymore, because they guaranteed those loans with the lenders. The Federal Housing Administration did. When the Federal Housing Administration guaranteed those loans, then those lenders got a guaranteed amount for those properties, right? Through the PMI. FHA no longer allows the PMI to drop off of a loan. If you're on an FHA loan and you're less than 20% down, that PMI will stay on the loan forever until you sell the house or refinance it to conventional. Conventional financing requires 3% down versus 3.5% down. And this still comes off once your house value reaches 78%. So the majority of what we write now is conventional. If the buyer doesn't qualify for conventional for whatever reason, and typically it's because on a conventional loan, You have to have money in the bank that's your own, and it has to be seasoned. An FHA loan, you can have nothing in the bank and a gift letter stating you can have that money and you can still qualify. So there are reasons that an FHA loan are in play now, but it's not like it used to be. Now, when we get to the FHA, yes, Taylor, it will be posted on the Facebook page to watch back. So,
Okay, thank you. I'm gonna have to hop off right quick.
okay. All of them
All
are
right.
posted. Julia will post them.
Okay, thank you guys so much.
Mhm. So on the FHA, again, the buyer or the type of loan, whether it be a 203B as in boy or 203K as in Kevin, loan amount plus any mortgage insuring fee not paid in cash as outlined below shall be insured by the Federal Housing Administration. Again, the buyer shall pay the discount necessary to secure such FHA insured loan up to a maximum of, and right now it's 0. No reason to buy a loan down. And the mortgage insuring fee not to exceed 1.75%. And that's a static number. 1.75% of the loan amount shall be paid by buyer as follows, amortized into the loan. An additional insuring fee of 0.85% shall be paid by buyer in monthly installments. So this amount, the 1.75%, is the upfront mortgage insuring premium that most lenders are quoting, and it's usually a large dollar amount. That's typically paid in cash at closing through the loan. However, they will be paying it back at 0.85% forever. Then we go on to it is expressly agreed that notwithstanding any other provisions of the contract, buyer shall not be obligated to complete the purchase of the property or incur any penalty of forfeiture or earnest money or otherwise unless the buyer has been given, in accordance with HUD, FHA, or VA requirements, a written statement by the Federal Housing Commissioner, Department of Veteran Affairs, or a direct endorsement lender setting forth the appraised value of the property of not less than, this is the purchase price. The appraised valuation is arrived at to determine the maximum mortgage the Department of Housing and Urban Development will insure. HUD does not warrant the value or condition of the property, and the buyer should satisfy himself that the price and condition of the property are acceptable. Seller shall, in addition to any other sums provided for herein, pay for all costs associated with obtaining the buyer's loan, which the FHA will not permit the buyer to pay, provided said costs do not exceed. Again, I always put in 150. There used to be a $70 fee that had to be charged to obtain a loan, and that fee is waived by 99% of the lending institutions now, but just put it there just in case. And then we have our last loan type, which is USDA rural development. And again, this is basically a conventional version of an FHA loan, if you will, meaning that when USD first came out, we didn't have a separate entity for it on the contract, and we handled it a different way. But now USDA and rural development is a bona fide loan type. Understand that USDA has its own requirements. The appraisal process is very similar to an FHA process. However, if the structure is being used to potentially operate a farm, small business, or anything like that, and there are outbuildings on the property, they will get appraised just like the house. Okay? If it is for residential use only, there's not going to be a business operated out of it, then they typically let the outbuildings go.
So when they appraise those, is it typical to have conditions similar to them?
I have seen farm buildings either be torn down or rebuilt based on the USDA. I personally paid to have a barn torn down on a deal that never closed. But it was the only way we could even find out it wouldn't close. So it cost me $500 to have it torn down, and the seller never reimbursed me.
It's not as bad as I was expecting.
So,
But still,
yeah, it was $500 out of my pocket that I didn't get back from the sale of the house.
oh, for sure.
So, but that does happen. Again, on USDA, those I would never write anything shorter than a 60-day contract. Because even at 60 days, chances are you're going to extend it 30. They take about 90 days to close. Closing in possession. Let's go back up here. That was a lot of information. Any questions on the new mortgage information, the loan types, the parameters, the fill in the blanks? Anything on any of that? We're all good? Perfect. Closing in possession. Contract shall be closed in a time and date mutually agreed to the parties, but in no event shall likewise be a time and date but in no event later than X time on X date. I usually always write 5 p.m. here. And the reason why I do that is title companies close at 5. If you put that it had to close by 2 p.m. on January 3rd, and it closed at 4 p.m. on January 3rd, contract really is out of date because you didn't meet the parameters of the contract. Just simple habit, 5 p.m. by whatever date you're closing. If possession of the property in the condition described in section 8 shall likewise be at the time and date mutually agreed to by the parties, but in no event later than, again, a time and a date. If you're writing an offer, typically you're going to write closing right here. However, it is not uncommon, specifically in this market, that this date is after this date. Because quite frankly, in these rushes of getting these contracts written and stuff, this seller may not have anywhere to go. They don't have anywhere to take their stuff. And if you have it written and your seller agreed that they have to be out by closing, they have to be out by closing. When I work with my sellers, I talk to them about this because it's very important. And I'll say, are you comfortable being out by closing, knowing that anything can happen at the closing table to either A, delay the closing, or B, make it not happen at all? Most times, knock on wood, I've been very successful in getting them closed and possessed the same day. But I want to take care of my sellers and ensure that they have a couple of days to move out after the property is closed. So I will put or counter back, we're willing to close on this date, but we're not going to give you possession. These days always wind up on a Friday, typically. I usually don't let possession occur until like 8 a.m. on a Sunday. I try to give the buyer at least one day of the weekend. if they have friends and family helping them move. But I also want to make sure my sellers have one day of the weekend to have their friends and family help them move, because at some point somebody has to clean the house too. So, but again, that's a seller decision. But if you accept a contract, make sure this gets discussed with the seller. Because if you inadvertently say, oh, well, it's going to close on January 3rd at 5 o'clock, inevitably your seller's going to call you on January 1st and say, hey, when are they getting the house, on the 5th or the 6th? And you're like, no, they're getting it on the 3rd, because that's what the contract says. Oh, well, we can't be out that soon. We haven't even started packing. Well, this is a very important conversation that you have with your sellers. For new mortgages, closing agent fees shall be classified as a buyer's closing cost. For any other financing, closing agent fees shall be paid by. It's a weird place for this to be. It's missed a lot. Read the language. For new mortgages, any of these, closing agent fees shall be classified as a buyer closing cost. So you don't worry about this. If you have a new mortgage, if your buyer's a lender or whatever, the rest of this comment, it does not pertain to you. However, for any other financing other than a new mortgage, the closing agent fee shall be paid by either the seller, the buyer, or split evenly between the buyer and the seller. This is not title. This is not owner's title. It's not buyer title coverage. That's not what this fee is pertaining to. What this fee is pertaining to is the actual closing charge by the title company to close the file. So when you have a simultaneous loan policy with a closing, it's going to cost your client $750. Typically $350 for the owner's policy, the lender's policy of title, and $400 to close the transaction. If it's a cash purchase, you don't have the $350 for the simultaneous issuance of the title insurance, but you do still have to pay the closing fee. That's what they're talking about. That actual fee to close the file. Does that make sense to everybody? Did I hit it too hard?
No. Does it just is that one of the things that just gets grouped into the final closing cost at the end?
Yeah, it's on the CD and the ALTA that it'll show that who's responsible party is. What Shelby asked was, is this something that's handled at closing? And yes, it's handled at closing through the CD and the ALTA. Okay, taxes and other items to be prorated. Taxes and assessments and any required homeowner association dues and or insurance due and payable for the calendar year, always the current year we're working on, or I'm sorry. Yes, it's always the calendar year you're working on. So this would be 2021 right now, and all prior years. Back up, slow down. Okay, I missaid that. Taxes and assessments and any required home association dues and or insurance due and payable for the calendar year blank, the year and all prior years, and a pro rata share of the current taxes, assessments required by required homeowners insurance dues, etc., as of date of closing. So 2021 and required homeowner association dues and insurance as of closing based on, and this is where you need to pay attention now. tax statements have come out for 2021. Once the tax statements have come out, you want to use the most current dollars. So even though it says 2020 and before, pro rata share of the 2021, which is now, because you got to pay it up to the date of closing. As of closing, based on, now we're going to put 2021 general taxes and 2021 special assessments. Prior to the issuance of the tax documents for the second half of the taxes to the county, to your lender, this is the prior year. So it'd be 2020, 2021. Once those statements are out and the general taxes is known for what it is this year, then this changes to the current year, which is 2021 and 2021.
When does that normally change?
Tax statements typically go out in May. But once I know I got my tax statement in the mail, I automatically change it. So it's when the tax statements are issued for that year.
And will we know at that point when that happens so that they?
Yeah, people will be talking about it throughout the office. Tax statements are out, change contract. That's typically the conversation that happens. And just make sure that everybody understands that you're paying through the date of closing. And again, for the purpose of the contract and saving yourself the hassles of an amendment later, write the word closing here. Because if you put a date here and it doesn't close on that date, and when you go back and extend the closing from here, you need to make sure that you also amend this, or contractually, your seller doesn't have to pay for the additional days that it extended because this date doesn't represent this date.
Should you just put closing up there also?
No.
No.
That needs to be the date because this is the actual date of closing.
Okay.
So that has to be closing. This needs, or that has to be a date.
Okay.
This can be closing.
Okay.
In the event of special assessment, see attached seller special assessment disclosure. Always, 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 without fail, check your property to see if there is any specials. The reason why I'm going to say that is this. Just because you have a house that is older in nature, not a part of a homeowners association, not a part of a new neighborhood, does not mean that there are no specials. There are potentially. I can give you 2 neighborhoods right now that have specials on them that you would never imagine have specials in your wildest dreams. And it's Peck. And it's the subdivision across the road from Peck. They have specials. They haven't paid out yet. Even those houses are 50 and 60 years old. What happened was, within the last 20 years, because they were 20 years special, those all used to be fed to cesspools for sewer. County went in and put all new county sewers in those houses. To do that, they had to go back and apply specials to the homeowners. So houses that were built in 1972, 1970, like I sold a house on Burton that was built in 1974. It still had specials associated with the new sewer. Now, it's amazing, you know, every agent that showed that house and wrote an offer like, are you sure it's got specials? I'm like, yeah, pull it up. Yeah. Got tired of having that conversation. And then Urban Hills up north did the exact same thing. They took away the cesspools, installed a county sewer system, went back, charged the homeowners the assessment, and those still have assessments on them as well. So always. The other thing is, if there is any situation that required a involvement from the code compliance department for Shawnee County, they don't show up as fines, they show up as specials. So you've got to check the specials tab, because if there's a weed cutting violation, if there's a vehicle violation,
Do
they
they
attach
always,
them as that.
because I've had them, I've had those come up on property, but I don't remember them being on county. I think it came up through title.
It was on, had to have been on county, because that's where it's assessed. And chances are, and I'm not pointing you out, you didn't check the specials tab, because it should have been there.
Gotcha. But had to be, it should have been.
Right,
So that's all in the county.
correct. It's on the county website. Marketable title. Seller shall make available to the buyer prior to closing the contract at seller's expense as evidence of marketable title, a standard owner's preliminary title insurance report, and after closing of the contract, a standard owner's title insurance policy that will insure the buyer against the loss or damage to the extent of the total purchase price by reason of defects in the seller's title to said real estate, subject to the exceptions below. Sellers shall be responsible to use due diligence to resolve any title defects at the seller's expense, subject to the exceptions below. If the seller shall be unable to deliver marketable title as herein provided, the contract shall be of no further force or effect. If you can't provide clear title on your property, you can't sell your property. And I will tell you, this happens a lot in sheriff's sales and foreclosures, to where they can't get clear title because of something that was on, it's a clouded title. It's called a clouded title, okay? We had one just recently with an agent in the office that there was a cloud that came up on the policy or came up on title. Unfortunately, the listing agent, and you guys have to remember, this is such an important piece of our documents. And Joe is going to be coming in here at 11:30 or noon, whichever. I know lunch is at 11:30, but Joe is coming in here to go over Title 101 again. You guys have to understand how to read title. And the reason why is it's your responsibility as a listing agent and a buyer's agent, quite frankly, to review that title to ensure that it is clean. If it's not clean and there's a problem, you need to ask questions.
And I like met with Joe just one-on-one, and she said just if there's anything on there, even things like, I didn't think about this, but if the owner died, just giving like a complimentary call, making sure that everything is clear with like the will and like everything like that, when they go to sell it. And just, she called it a complimentary call, just
Right.
giving a complimentary call, hey, I saw this, I just want to make sure everything is good, because if there's any like seller requirements in order to get clear title, it can delay closing.
Exactly. And that's a very true statement. And what happens a lot of times, when it comes to a death, for example, the family rushes to list the house. It's like, mom and dad are gone, we're selling the house. If they don't have an estate, if they didn't have a will, if it wasn't in a living trust, nobody can sell that house until it goes through probate. So if it hasn't gone through the probate process after the death, if there was no final declaration of that residence through a means prior to the death, it can't be sold, because it's an asset of the estate, and the estate expenses have to be settled before a property can be sold. And probate requires that they send out 3 notices in public venues that says, hey, this person died. If you have any outstanding claims against this person or their estate, you need to file appropriate paperwork with X person, okay? It has to go out. It's a law. It has to go out 3 times. They have to be staggered so many months apart. So you need to make sure. The other thing is, if you are dealing with a surviving spouse of a joint tenancy with right of survivorship, that property automatically goes to the surviving spouse. Okay? So they can sell it. If you have, and this gets really tricky, and there are a number of houses, I won't say an abundance, but I will say a number. And this actually happened to a good friend of mine recently in Louisiana. Her mom and dad were married to each other forever. They owned their house together forever. And she called me frantic from the attorney's office saying, they're saying we can't list the house, that it has to go through probate. And I asked her, it was real simple, is there a will? No. Okay. We have no declaration of that property through a will. Were they in joint right of survivorship? She said, what does that mean? I said, just ask the attorney. Were they joint tenants in common? Or were they joint tenants with right of survivorship? The attorney said they were joint tenants in common. I said, then your mom doesn't own the house. She said they bought it together. I said, doesn't matter. Your mom and all three of you kids own the house. Because it was tenants in common, dad's share automatically drops to the next level of heirs. So now instead of mom owning it wholly, she now owned it with her three kids. And they all had to sign affidavits, and they all had to sign quitclaim deeds to give the house to mom so that she could dispose of the house, or it would have had to go through probate. So if you have an elderly couple in a situation, joint right of survivorship has not been around forever. And that's one thing that does come up on title on occasion. The other thing is you have to prove the death through and it cannot be under any circumstances, a copy of the death certificate. It has to be an original. So if, in the example that Shelby gave, if you don't have your surviving spouse and you do not have a original death certificate, the surviving spouse better be getting on the phone with the funeral home to get an original death certificate, because they cannot file a copy with the register of deeds. It has to be original. Meaning that it has to have the seal on it. Huh?
And sometimes those take time to get.
Right. Depends on how long they died. If the funeral home is still open, then you have to go back to the vital statistics. It can be a journey. But that's one of the things that is so important when you're reviewing title, because it will show up there. Death certificate of such and such must be presented with the deed, or whatever, however they say it. Another thing that comes up in title a lot of times that will stop a sale is any judgments or lawsuits that one of the sellers is involved in. Child support is probably one of the biggest, but it falls second to taxes. If you have outstanding taxes anywhere on anything, it can be filed on the title of your house. I had a client who owns a business in town, sold a rental property, never disclosed to me that there were back taxes on his business. It came back through title that there were. I lost a really good friend over this deal, so this is a rough one. Dad had several $100,000 in back taxes funds Wife didn't know about it. Kids didn't know about it. And when they sold a family property, it all got thrown on the table. And everyone blamed me. I'm like, how can you blame me? We even had the title company sit down with them to explain it because he thought it was hidden. Nothing is hidden. If you've got a judgment, it's gonna come up. The house is tied to you, it's in your name. The government is gonna get their assets however they see fit, and they will attach it to your properties. They cannot take your primary residence, but they can take anything that is deemed an investment property. So in this particular situation where they owned the house outright and it had been a rental, we were too far into the process to stop it. The seller could have killed it at that point in time and said, we're not gonna sell it anymore. We're turning it back into a rental. I'm not giving the government the money. Because once it came out that there was zero proceeds for the sale of this house, it created quite a storm with the family. But what we had to explain to them was, you are getting all of the proceeds. They're just going directly to a debt.
Yeah.
So you're not getting a check for 90 grand, but we just lowered your debt to Shawnee County by 90 grand. Still didn't work for them. They still weren't happy. And it was still all my fault.
Unfortunate.
But I can't bear the brunt of somebody's secret lives. But that kind of stuff will come up in title. Read your title. It's very critical.
Chris,
Yes.
I heard about the death or what have you in regards to the title. And what I've noticed a lot is elderly people who have homes or what have you, and they have no one. They're going to like nursing homes or what have you. Um, and like you said, the will to the surviving spouse or what have you, like a single lady, she's elderly, going to a nursing home, disabled, the conditions change. How do you deal with that in regards to the title, someone who is of age, going to nursing home, still have that house, and how do you deal with that?
Well, there's several things they can do. One, and this is fairly common and it's becoming more common now than it had been before, but there has been an upswing in what is called transfer on death deeds, TOD. And what a TOD does is it gets filed with the Register of Deeds office immediately upon execution. And you paying to add that page to the deed, okay? But in the event, say Shelby and I say I TOD'd my property to Shelby. We're not related, well, we are related, but she's not my wife, she's not my daughter, okay? I can TOD to whoever I want. There is nothing to preclude me from doing that. So my house is paid for, my house is good, whatever. I'm going to transfer on death my property to Shelby. That deed sits behind the functional deed at the Register of Deeds office as a recording until I die. Once somebody proves I died to the Register of Deeds through a valid original death certificate, again, the necessity of a valid original, the deed automatically gets closed and the new deed comes forward. Now, by circumstance and happenstance, Shelby now owns my house 100%. So you don't have to deal with probate. You don't have to deal with any of the heirs. You don't have to deal with anything. because I took the steps prior to my death to deed my house to Shelby in the event of me dying.
You could rent that house. Can the owner rent it out? Like if she go to the nursing home, could she rent that out, her home?
Yeah, she can do whatever she wants. She owns it. Just make sure she's protected on the back end through a transfer on death deed, a will, or something. There has to be an executed document of substantiality and legal to verify that that house goes to another person.
But be careful if she's going to a nursing home to live, because then that changes if she owns her home, and it changes greatly, because then they can take her home to pay for her services in the nursing home. So it's a very, fine line. You need to make sure it's not, she's going to one of these areas in Topeka where elderly can live without services. Once they transfer and have to have services, if she still owns that home, they can't take it.
And she's absolutely 100% correct on that. And we actually have an agent here. Just have all kinds of things. We have an agent here whose dad's wife passed from Alzheimer's disease. Well, they thought they did it the right way, and again, did it the best way known to do it. I sold them their house originally, this couple. Their daughter's now an agent. But anyway, I was their agent prior to. Sold them the house, learned that the wife was ill after the fact, kind of educated them on how to do it, but it never got followed through with. What happened was they took all of the living assets out of her name, put them into his name, so that she would qualify for Medicaid, and Medicaid created a spin down. Well, in that spin down benefit, the house was included because they go back 7 years.
Mhm.
And if you had an asset within the last 7 years that they can go look at and say, oh, well, you tried to skirt this from us, guess what? You just got caught. They can now force a lien on your property for all those unpaid medical bills that accrued during that spin down. And they can force the sale of the house to satisfy those after the surviving spouse dies. That's the key. They cannot make you homeless, but they can take the house away from your heirs and sell it before you ever get anything. Okay? So be very careful. Never give legal advice in that situation. Send them to an attorney. Just tell them there are potential legal ramifications of doing what you're doing. You need to contact an attorney to make sure it's done the correct way.
Okay.
But that is what I guarantee you without fail, that is what will happen. They will go back after the property. I have a friend who's an attorney who does this. I'm not proud of him for what he does, but it's a living and he has to feed his family. But when people get involved with Medicaid, spin downs, and those kinds of things, there's ramifications to that. Nothing is free, is what I will tell you. I am not excusing you from who's training you?
Something that Sora sent out about financing with US Bank at AJ's Pizza.
Who goes that?
Yeah, if I don't
Eat some
go,
serious pizza.
if I don't go, they'll charge me $50.
Oh, yeah, and then you could have had a whole pizza. See you later. Okay, so, any questions on any of that? All right, the seller shall convey title by general warranty deed or a deed acceptable to the title company issuing the title insurance to be delivered to the buyer at closing of the contract upon receipt of the total purchase price, free of all liens and encumbrances, except these right here are the exceptions that are always listed on every single title. So any zoning conditions, restrictions, deed restrictions, reservations, right-of-ways, easements of record, if any, which do not materially affect the value or prohibit the use of the property for residential use. Encumbrances created by the buyer, that's why they sign the seller's affidavit stating that they have not entered into any lending of dollars pertaining to that property. So they're saying right here, any encumbrances created by the buyer aren't going to be covered. Installments, if any, of special assessments not yet due. Again, go back to the special assessments form. Tenants' rights, they're either not applicable or existing. If you're selling a property that has tenants in play, you have to protect the tenant's rights. They are protected by the Tenant Landlord Act. Okay? So if you know there's tenants in place, you know there's leases in place, then tenants' rights in place. Okay. All right, tenants' rights. And any other exceptions, just write none known, because you're not gonna know of any. There's no way you can know of any. It's long down the road at that point. So, residential use, NA or active in place, none known. Now, we'll go down here to liens. Seller shall pay all contractors, subcontractors, laborers, or suppliers for all work done or material furnished to the property prior to the closing of the contract, which might form the basis of a mechanic's lien. Seller shall identify and hold fire in real estate companies and licensees involved in the transaction harmless from any obligation for payment of any amounts by reason of any mechanic's liens, which may be filed for labor performed or material furnished prior to the closing of the contract. Make sure, and again, this shows up on title. And if you have a seller who doesn't pay their bills timely, and a vendor finds out that a house is for sale, it's like 15 or 20 bucks. I can't remember how much the filing fee is anymore. It's very minimal. They can run down to the Shawnee County Courthouse and prove that they have not been paid for services rendered and attach a mechanic's lien on the property. What that does is it ensures they're getting paid out of the proceeds of the transaction. It will show up on title. I have actually seen it show up on title when they pull the final copy of title the day before closing. It has been filed between the date the title was pulled and the date the title gets repulled. They always, without fail, will pull title the day before closing to ensure nothing has been added as a condition. They will also always, just FYI, pull a credit bureau report for the lender, not the title company, but just general knowledge for you guys. A lender will always pull a final version of the credit bureau report the day before closing to verify that that buyer has not gone into debt for anything other than that house in the previous 30 days. Because if they have, and it throws their DTI out of whack, they will not close the loan. And there is nothing more heartbreaking than sitting in a closing room and have somebody say, oh, wait till closing's over, I can't wait to go show you my new car I got. And the closing officer saying, what? And literally, the conversation took place that the buyer went and bought a new car in celebration, and it had not hit the credit bureau report yet because the first payment wasn't due. However, the lender was in the closing. By law, she had to say, stop the closing. We need to rerun your numbers. The payment threw out her DTI. She could not take the car back. She could not buy the house.
If she had her car.
Yeah, I was gonna say, at least she had a car.
But it was,
Oh.
that was the absolute single worst closing I've ever been a part of. I don't ever want to do it again.
Is that why they tell you not
Do
to
not.
open? Is that why they tell you not, the buyer not to open up any accounts, credit cards, or anything to after closing?
It's exactly why. Because I will tell you the other thing that always, I won't say always because it's not an always, but I will tell you another thing that has happened frequently. And again, this is rein in your buyers, you guys. You've got to talk to your buyers. They have to understand. You cannot buy anything. You cannot spend any money that is in your accounts other than your normal monthly living expenses from the time they pull your credit and you go under contract till the time they pull your credit when you close. I have had to rein buyers in. I've had to take calls, at the 11th hour. People are at Nebraska Furniture Mart, and there's an amazing one-day only sale for appliances. It always happens over Labor Day too.
Yes.
They have their Labor Day appliance sale. But Chris, I've got to buy these. They're perfect. They're exactly what we want for the house. And I'm like, you can't. What do you mean I can't? You can't. If you open a credit account with Nebraska Furniture Mart to buy $3,800 worth of appliances, it's going to affect your credit on the final poll. Call your parents, tell them to buy them, do whatever you have to do. Don't buy them. And what I will tell you is Nebraska Furniture Mart is awesome about holding those open till they know the date of closing. So they will work with you, just don't ever do it. Don't ever do it. Go with the assumption it's gonna backfire because chances are it's going to. Now,
I see your face at closing when they said, you're probably going.
I was like, what? I was like,
Horrible.
it was horrible. So, all right, I'm gonna go ahead and call it. It's 11:30. We got to page 3. We will go over the rest of page 3 next week. Again, I truly appreciate you guys and your time and you allowing me to fully explain the contract so that you understand it. It's very important to me that you guys go out there and know what you're talking about with your buyers and your sellers to ensure that everybody is going to have the best situation ever. So, okay? Any other questions?
No.
All right, we're gonna stop sharing. Everybody have a great day.